All right, gang. So in this course, we're going to cover the relative strength index, also known as the RSI. So the RSI is a pretty important indicator. There are lots of other indicators that's very similar, but I like to use the RSI because what it does is it's going to basically highlight, it's going to show us the strength and the speed of the underlying stock, like the price movement, what's going on there, right? So when you're looking at a chart, you see the price moving itself, but you don't know the momentum. You don't know the speed of the rate that it's moving. So that's what momentum is. So you need an indicator that can highlight that for you, right? So that's what the RSI is going to do for us. It's going to highlight that for us, which is the momentum. It's also going to highlight oversold and overbought conditions, which lets us know if, the buyers are tapped out or if the sellers are tapped out. If we're getting exhaustion, where we have, these highs and lows based off of the price movement itself. And then also, it's going to let us know triggers. So also going to give us triggers when to enter, when to exit. So those are all the things I like about the RSI. And we're going to cover those in this lesson here. We are going to start off with a little bit of math, but you do not have to do any math. So I know you're probably cringing over there when you saw the Excel, but this is just so I can explain to you and demonstrate to you how the RSI works on a molecular level, basically the basic mechanics of it. So if the inner genius in you wants to dial in and really get involved in this, you can. It is totally unnecessary because the software is going to do this for us. So this Excel spreadsheet will be included in the materials section in the course, so you could download it if you want to. If not, then you're perfectly fine. So I'm going to go get through the math quickly so that we can get to the chart so I can show you how this stuff works. So basically, what I have pulled up here in Excel, we have stock price changes from the stock Apple from the beginning of the year. So year to date is what we're looking at. All right. So in this column here, we do have the dates. Okay. It's all the dates. And then in this column here, we have the prices. So every day that ended, what was the price? What did the price end at? Right. And you can pull all this data from yahoo.com if you want to get the prices of any stocks, and you can plug them in yourself. And what we did in this column here is that we took the prices we took the prices from the previous day versus the day that we're looking at and subtract them out so that we can see what was the change in price. Did that stock move up that day or did that stock move down that day? And so it's red because that means that it went down. Okay. If you look at this number 2 here is down $2.92. The next day was down $2.37. This was up $1.41. Okay, so we can see the days that it was up and the days that it was down. And these calculations are important because it's going to help us to get our relative strength calculation together. And so what Wilders did when he created this indicator is that he took the days that were up. So we got this column here, which basically has all the up days data in here. And then we separate that from all the days that were down. So we're just basically trying to figure out how many days were up, how many days are down, what was the price of those up days? What were the price of those down days? So we do have a, little more sophisticated, function in here, a formula. And you guys can see it here. This is an if statement. And basically all it's saying is that it's going to tell Excel that if the price of the day, the time frame, the day that we're looking at, which is January 3rd, which is 297. If 297, right? If the closing price of January 3rd is greater than the price closed on January 2nd, the day before. If the day here is greater than the day before, then we go to the next stage. The next stage is you're going to tell Excel to do a calculation. So the calculation you're going to tell it to do is to basically subtract January 3rd price from by January 2nd price. If that is so that's basically what it's doing for that. So the if statement is saying, hey, if this price is greater than that price, if that's true, then perform this calculation here. If that is false, then go to the next one. Here we have a comma and there's no space in there. That's basically a 0. And so basically what Excel is going to do is going to compute a 0 for us if this statement here is false. Okay. So if 297 is less than 300, meaning that it's not greater than, then it's going to give us a 0. And that's what you have. So we have a 0 here. And then this function goes all the way down. This formula goes all the way down. So the days that was true, it gave us a calculation. The days that it was false, it gave us a 0. And we do the same thing on down days, but except for doing greater than, we did less than. Okay? So that's going to get us the up days in that column and the down days in the next column. The next one here is going to average out 14 days. So we're going to take 14 days we have right here, and we're going to average them out. So we just did an average formula here, average up 14 days. And that's going to give us the average of all the up days within that 14 period time frame. And then the down average column here is going to do that for the down days. It's going to average them out. So this is how we're going to get that nice strength in here, because we're just averaging it all out. And the next formula here, you don't even have to worry about it, because again, you don't have to do the math. But it's basically going to, roll all of this, and it's going to actually do about 14 days here, which you got 14 in this top row here, 14. And then you'll see that the rest of these formulas are all dragged down, basically. Okay. So it's going to basically average all of our up days and average all of our down days. That's basically what it's doing. And once we get the average up days and the average down days, right? It's a rolling, moving average period. That's basically what that formula was doing for us. Then we're going to go to the next column, which is going to give us our relative strength. And relative strength is basically up average days divided by the down average days. And it's going to give us our relative strength. That was easy. Okay, that was easy. All right, hopefully I haven't lost you yet. All right, we're almost finished. And then this next column here, these are the same functions. This is the relative strength index. So this is how we're going to get the relative strength index. The formula is to take 100 minus 100 divided by 1 plus the relative strength number that we just computed over there. Now, there's another way to do it that's I like better, which is this. We're just going to basically take the up average days divided by the up average days plus the down average days, and you get the same number, except you get like it in a percentage format here. So I like that calculation better than this calculation, but they all lead to the same thing. Okay, so that's how we compute and get the RSI. All right, and again, you guys can download that. You can play around with it if you like. We're going to move forward here so you can see the charts. What's important here is that we have the charts that we form get from this data here. Top chart here we have is the RSI, and in the bottom chart is the prices of the stock itself. So the days, you can see the changes in the price on a line chart here. And the RSI, we can see here, you can see I got this red line that's right here at the top and a red line that's at the bottom. That line, that's what's important about this indicator. It's really important. And to me, it reminds me of like a basketball court or a football field, right? You have out of bounds on one end, right? One team is going to the other end, and then they switch and things like that. So it's all about that out of bounds period. And you play within the end, within those bounds. Those boundaries on the RSI is going to be the overbought and the oversold. Now, the indicator, the bounds are at the 70% and the 30%. Now, you can customize these. You can change these. So some traders like to use an 80% and a 20%, but standard is going to come in at 70 and 30. Okay. And again, you can modify and customize these if you like, but most traders are using 70 and a 30. So 70 is if the oscillator moves up to that level, it moves beyond this level. If it breaches this level, then that is an overbought territory. So overbought territory just basically means that too many buyers are up here. The prices are too high. And so what you typically will see in this situation is that the price is going to get that trend, right? That rally should see exhaustion. That means that it should be dying off and then eventually reversing when it gets to overbought territory. Now, if you come down to the 30% line down here, this is the oversold territory. So the oversold territory means that the price has, sold off so much that there's pretty much nobody left to sell to, right? And so what happens with that is that you get a reversal, okay? So traders like to play these on the RSI, the bounds, as an indication of places to get in, places to get out. Also, this is a leading indicator. So it's going to give you some insight into the future when you see the momentum itself. So if we look at the prices in between those boundaries, we have a 50% line that's right in the middle. And if the momentum oscillator, if it's tracking above 50, then that is bullish. If it's under 50, then that's bearish. But the way I like to look at it is I like to see the trend of the oscillator itself. Now we see the momentum started to go down here, and that happened before the price started to go down. So once it started going down, once it crossed under, that was clear indication that, hey, this thing, the trend is reversed. So that's what happened right there. And then once we see the momentum start to pick up, the trend in the momentum itself is picking up, and then the price follows afterwards. So you will see the RSI is giving you idea of the momentum, which you see that before you see it show up in the price itself. So this is a really good indicator. So what we're going to do is actually go to our platform. So let's remove that. And we're going to stay on Apple chart, which we were just looking at here. And we're going to build some indicators here. Now, this is real time. So I'm going to take off some of these lines here because the price has breached those levels. If you guys recall in the Fibonacci class, that's what we were going over. So I'm going to leave that just where it's at. Now, what I want to do here is we're going to go to studies, which already have the RSI indicator here. We're going to go to edit studies, just in case you don't have that. And I'm going to just delete this. All right. And I'm going to delete this as well. And this is just, again, if you already got it there, then you're fine. But to show you how to make this from scratch. So we're going to go to RSI. We're going to hit add. And when we hit add, we're going to double click on this. And we're going to leave everything where it's at. All right, 14 periods. As you guys saw, that's what we were dividing the averages by 14. Well, there you go. The length is 14. The overbought is 70. The oversold is 30. Closed price is what it's measuring. Wilders, he's the guy who actually made the indicator. So we're going to use this average type. The calculations in there, that was the Wilders calculations. And then show breakout signals. I want to turn this on. Show the breakout signals is going to give us those signals, those up arrows and down arrows to give you indication. Those are your triggers to get in or get out. That makes things a little easy. And I'm going to go to on the plots, and we're going to plot the oversold and the overbought levels here. And they're already at purple right here. I actually kind of like this purple color, so I'm going to just leave this at purple, oversold and overbought. And our up signal is actually red. That's not a good indication to buy. So I'm going to change that to green, because if it's up, then that means that I need for it to, when I look at the chart, it's going to let me know that this is where I need to buy it. Green represents buy to me. And then under the down signal, we're going to go to red. That means to sell. So once you get that together, you're going to hit OK, and you can hit apply. Okay. So I hit apply, and I got it in there. But I want to do something else. I'm going to go back into this here. And what I'm going to do is go to my RSI line, which is already here for us. The color says it's black. I don't like using black on this because we're using a dark background, so dark blue. I want to use white. I'm going to click on white here. I'm going to hit OK. And then I also want to make our oversold and overbought territories thicker. So I'm going to go and change that to the number 2. Let's go to number 2. Then we're going to hit OK. Then we're going to hit apply. All right, bingo. There we go. Hit OK. All right, cool. So I'm going to pull this up. Actually, I still got the squeeze in there. I'm going to remove that as well. So I want to see one indicator here. You guys don't have to remove it, but I just want you to see how this indicator, if you already got those indicators, you can leave them there. What's important is I want to show you how this thing is working. All right, so we've got our RSI indicator here. And you remember how we were just looking on our Excel chart, the oversold and overbought territories? Those are really important. So if we go back here, look at this zone right here. Actually, we can go back here. Once the momentum here, we see that the RSI got into the out of bounds levels right above 70%. This is an indication that, okay, price is too expensive on this stock. Buyers, they're not really willing to go higher at this point. So then you start to see the exhaustion. So we can correlate that with the price movement on a chart above. We saw we got a little dip here, right? So it came down and it dipped. Okay. And then it came back up though. All right. And then it dipped again. All right. Then it came Then it finally broke right here, and then it started coming down, but then it reversed. Okay. Now, what I'm going to do is, before I even move forward, what I want to explain to you is that a lot of things are changing in the markets, okay? Versus back in the day, today we got a lot of algorithms and computer trading. The environment is much different, today than it was back in the day. So some indicators, they don't operate in the way that they were designed. And a lot of it is due to some manipulation that we have in the markets. We do have a lot of manipulation where, right now we have, currently in real time, we have the Federal Reserve just pumping in a lot of money. That's causing distortions. And if they work the way they intend to work, then you get better signals. But when you have interference in the markets, it can throw things off. So don't expect for it to be 100% accurate. However, you never want to ignore the signals. So you do get some signals that you would call, not necessarily false signals, but as of the past few years, we noticed that the RSI has a little more play in it than it normally would, where the price you'll see it'll stay in the overbought territory for extended time periods, more than it normally should. So we may see it, but it doesn't mean that we're going to make a move based off of it. This is just giving you some insight that, okay, price should be reversing at this level. So we want to use this indicator along with other indicators before we make our decisions. As you see with our charts, we do have moving averages on here. And what you learned in the moving average class is that when it crosses over, that's, your trigger to get in or to get out. So although we saw the price, if we go back here, we saw that we were in overbought territory. Just notice that our moving averages never crossed. So we never got a trigger to sell. This was just a heads up. So there was some the price did change, but it wasn't enough for us to get in to trigger the short, right? So just keep that in mind. But if you look right here in this zone, when we got into all of this, price started going crazy elevated right up in here. And we see we were way overbought. So anytime you hear me narrating any video saying, oh, price is too expensive, this is what I'm talking about. It's overbought. Now, when the price is in the overbought territory, you don't want to be a buyer in this environment. You don't want to be a buyer. Even though price is moving up, that's fine. You can't catch every perfect move, but this is how you can really time things. It's giving you an idea of what's coming, okay? It's telling you that the buyers are exhausted. These prices are too extended. So we got the indication here. Then we got the sell triggers right up in here. And the crossover tells you basically that's a trigger that you can use to sell. So boom, says to sell. And then the price finally came down in this area down here. So we see the momentum. So we're tracking the momentum down here started moving before the price came later. So this is like, okay, you have your warning. This is too overextended. And then the momentum started coming down. And then when it crossed under, that means that the trend, is basically reversing. Okay, so the price was still up. Momentum was going down. This is where you had divergence. Okay, but that's giving you some insight that, hey, this is what's coming. So if you would have knew that, you could have had your shorts in there. And then once the price broke, you'd have, reaped the full benefit. So that's basically how you use that RSI. And you do get some indicators like, look, right here, we didn't even get a trigger here. Okay, so that's fine because we have other indicators that we're using along with this, but we can at least see that the price, the momentum starts to shift. So then we can flip over and say, okay, well, I can see the momentum is shifting upwards. So that means that the trend should continue upwards, right? And back here, when the momentum shifted downwards, that means that the trend is reversing to downwards, and that's what happened. So we can use it for that. And then we use it, for the momentum, the oversold and overbought areas. Those are zones that give you some indication in the future. And then the triggers, once it crosses the 70 or the 30, you use those as triggers, basically. But again, you don't want to use this standalone. You want to use it along with some other indicators, so you got a clear signal. But this is a really good indicator. I don't place a lot of weight on it right now because of the manipulation in the markets. They can stay extended. They can stay in the oversold or overbought territories for an extended period of time. So what you want to do is wait till you get that crossover. When you get that crossover, it's a stronger indication, what's to come. So anyhow, I hope you guys really enjoy this class, and I'll see you in the next classes. But also remember, there's other indicators that do very similar thing to what the RSI does. You have your stochastics, the MACDs, the CCIs. They're all pretty much very similar. So they work in a similar way. So some of those courses we may cover, some we may not. But if you understand how this works, then you can understand how the rest of those will work. All right. So you guys have a good day. Catch you in the next class. Peace.